This is the L2 Capital Podcast with hedge fund manager Marcelo López. The L2 Capital Podcast focuses on potential opportunities in the market and brings to your industry leaders and an intelligent conversation about their respective areas of expertise. And now, here's your host, Marcelo López.
Hello everyone and welcome to the L2 Capital Podcast. I have a very special guest today, Bram Vanderelst, a uranium trader. Very little is known about this profession, and I personally spoke to Bram when I was in London in September and invited him to come to this podcast, which he very kindly agreed. So today we're going to find out a little bit more about a uranium trader's job, what they do, how they do it, and the importance of their actions for the market. And to help us understand it better, Bram, who is a chemical engineer, will shine a light on the subject. So Bram, welcome to this program. It's a pleasure to talk to you again.
Thank you very much, Marcelo, and thank you very much, everyone, to listen to this program. I'm happy to shine some light on the uranium space and give some insight as to what the dark arts of trading are.
Brilliant. So to start with, could you please tell us a little bit about yourself, what you have done, and how you ended up as a uranium trader?
Yes, no problem. So my name is Bram Vanderelst. I'm currently the head of uranium for a commodity firm based out of London called Curzon Resources. We trade under the name Curzon Uranium Trading. It's a firm where we have a dedicated uranium desk, which basically means that we buy and sell uranium and are active in the markets, both on the spot market and on the long-term market on a daily basis. Personally, I rolled into the uranium space in, I think it was 2014, when I joined Itochu, the large Japanese trading house, and I joined them on their uranium or their nuclear desk in the London office. Prior to that, I had done other commercial roles in different commodities and in different settings. But in 2014, so I ended up working for the Japanese and getting to know uranium. And as the saying goes in the nuclear space, once you roll into it, it's very hard to get out of it. So I've been in it for about 6 or 7 years now, and I'm still very much enjoying it. It's a niche commodity. It's a very small market with a limited amount of people, but it's a very enjoyable and very nice market in the sense that it's we all believe the fuel for the future. So it's nice to be part of that.
Excellent. So what exactly does a uranium trader do? You mentioned that it's a niche market. So, and how is the market?
As a uranium trader, much like a lot of other traders, it's very simple. We buy and we sell uranium, and that's at least the simplicity of what we do. In reality, it gets a bit more complicated. Obviously, we're active on a daily basis into the market, and as a uranium trader, you have a function in the market as well. So you're not just trying to make some money in the middle, but you provide liquidity to, especially in nuclear fuel, which is much needed. That generally is a gap between when producers want to sell their commodity or their uranium, which is usually as quickly as possible after they mine it to convert it into cash, and when nuclear utilities or utilities who run nuclear reactors, when they need to buy the uranium, because there's usually long lead times before they need it and before they actually need that material. So as a trader, you provide a liquidity function, a time swap function, but you also provide other optimization functions in the sense that the physical movement of uranium and the physical attributes might not really align with where buyers need their material and where sellers are selling their material. So traders can smoothen these things out. So effectively, as a trader, you're a solution provider to the industry, and obviously in the middle you make some money out of it, ideally. But it's very much about providing solutions to buyers and sellers.
Brilliant. Because that would be my next question, because utilities are big companies with deep pockets, and uranium mines could also be big guys. So why would they need traders for, and the importance of a trader for this market? So you pretty much answer that in this question. But can you describe to us your day-to-day activities from the moment you arrive in the office until you leave?
Yeah, no problem. I mean, first of all, the most important thing is we check on the markets, not just when arriving, but throughout the day. Uranium is an actively traded market throughout the day. From it's a 24-hour market. It gets traded from all the way from Chinese hours to the late American hours. So the market price changes, and we keep an eye on that, obviously. We're also very active in talking to other market participants, whether it be our peers or whether it be the producers, the buyers of uranium, because we're always scouting around for opportunities and trying to find out where we can actually add some value. Very important as well to be able to actively be a market participant in this space is that you understand the space well. So we do a lot of, especially we at Curzon, we do a lot of fundamental analysis, meaning that we try to understand exactly what drives this market, what the drivers are in the sense of supply demand, what sort of effects the news can have on the market. So we're obviously very well in tune with whatever drives uranium and nuclear practices, which can yield from Chinese policies on energy all the way to temperatures in France to understand whether they need to shut down their reactors if the rivers are getting too warm. So it's a pretty all-encompassing space to keep an eye on, and that's roughly what we do on a daily basis. And obviously, we in the meantime we also conduct our normal business where we do our purchasing, our selling, and everything that's related to that.
Interesting. So you mentioned there you talk to utilities and other traders all day, read many reports, and have your finger on the pulse of the market. So how are you seeing the uranium markets today? Is the market getting tighter? Do you think prices are fair at these levels, or do you expect them to go up in the near future? What is the sentiment towards uranium at the moment?
That's a very good question and a bit of a difficult one to answer. But I guess the uranium market, it's obviously tightening on the supply side. And it has been tightening for a couple of years now, where we have seen some important mines, most predominantly McArthur River in Canada, shut down recently or last year. There's been some other cuts in the uranium market on the supply side. So from a supply side perspective, the uranium market is really been tightening. But to really understand what's happening in the market today, we need to go back all the way to Fukushima, because Fukushima was the main driver for the market that we find ourselves in today. And shortly after Fukushima, there's obviously been a lot of demand gone offline. Germany is closing all their reactors. Obviously, Japan has shut down all of their reactors temporarily, some of them. But so the supply-demand balance changed dramatically after Fukushima. And a lot of what we're seeing today in the market is we're still sort of reverberating from that effect. The few years after Fukushima, there was a lot of material on the market and a lot less demand. So there's been a lot of inventory building up, a lot of overhang, which is knocking around the market. And only over the last few years have we actually seen inventories coming down again and the market into a more balanced position. If we then look at what the situation is today, we're looking at a market where the supply-demand balance has shifted from an oversupply into an undersupply, at least on a purely annual supply-demand balance basis. And what that does, it tightens the market in the sense that if there's an undersupply, obviously that material needs to come from somewhere, and therefore inventories are released back into the space, and previously built up inventories are now coming into the market to fulfill these demands. This is a tendency that we're seeing moving forward as well, and with each year the market tightens a bit further, and the sources available for supply become scarcer and scarcer, to the extent that we see only a few main sources in the market right now, predominantly obviously Kazakhstan, and then Australia, Canada, and Niger. But all other sources are really drying up, or at least are no longer available in the Western markets. So we are seeing a tightening market. Prices have started increasing again, first at the beginning of this year, but then they sort of went back down, and they are increasing again right now. The actual time frame on what's going to happen with prices and moving forward is quite difficult to predict. I think most of the market participants are in accordance in the sense that, or all agree that if there's no new supply coming online, then we will see increased prices in the 2020s. But it's very hard to say when and how that is gonna happen, because the overhang of inventories and the release of inventories into this market.
Brilliant. You mentioned the inventories. Do you follow the available inventory in the industry? Is it possible to track it? Can you tell us a little bit about it?
It's a lot harder to track than some other commodities. So there's very little publicized data on inventories, unlike what you see in, for example, the oil market, where we can see inventories quite a lot more openly. There is some public data available on inventories, predominantly from the Western world. So on an annual basis, both the US and European institutions, they publish what the inventory levels are in the industry. But from there's a lot of pockets of inventory that are harder to pin down, which is predominantly China, Japan, Korea, and some of the other Eastern nations. So as much as possible, we try to keep a view on that, and we obviously do have a view on that, but it's hard to really estimate it completely accurately.
I got it. So Cameco announced that it wanted to buy at least 10 million pounds of uranium between now and the end of the year. What do you make of this announcement? Do you think they will push prices up?
Again, a good question. Yet again, a difficult one to answer with a simple answer. Yes, Cameco has publicly announced that they need to buy X amount of pounds for this year, and they will obviously do so because they need to use those pounds to fulfill sales contracts that they have. So when they put McArthur River down, they still have the obligations of the sales contract, which they need the material for. And a big question whether that will have an effect on prices in the short term is the extent to how Cameco buys that material in the markets. What we see is that there is still pockets of material available in the markets, predominantly, again, the Kazakh sources, which come into the market, in the spot market, in various different avenues. So the real question is, which sources are larger? Is Cameco's demand, the 10 million pounds you state, is that enough to absorb all of that material that's available? Or is there more material available that's willing to come into this market and be placed? And if Cameco doesn't really buy aggressively on the spot market, then there won't be much of an effect. But in reality, you can never really discuss this without discussing prices. The material available at the current price levels is obviously going to be a lot less than the material available at price levels that are 30, 35, maybe 40, whatever those levels might be. In theory, yes, obviously it's a positive, the purchasing by Cameco is a positive effect in the market, but whether it will have a big effect this year is very much due to be seen, and we need to understand how Cameco goes about purchasing this material.
Got it. Is it possible to see different prices for the same material? Let's say 1 million pounds of uranium in Canada might trade at a premium or discount to the same material in Europe?
That is possible. There's obviously an element of arbitrage between the two prices, because if you shift the flow of material, then you can obviously arbitrage that out. But the market does diverge every now and again between the different locations, mainly because to understand that you need to understand where utilities buy their material, which are ultimately end buyers of uranium. And they buy their material wherever they need to have the material converted to UF6, which is the next stage in the value chain of uranium. And if there's more demand at one location because more utilities are nominating that location as a delivery point because that's where they're buying the next stage, then the prices might temporarily diverge between the two locations because there's just more demand. But ultimately, that will always be leveled out because of the arbitrage that's available with the actual physical material.
Got it. So do you think it's possible that what happened to the conversion market could also happen to the yellowcake market?
I think the conversion market is a very good example of what long-term will happen in uranium and is very likely to happen. Conversion is obviously, it's an even smaller market than it is than U-Trade is. There's less actors and there's less people who produce it. So in that sense, what happened in the conversion market with Converdyne shutting down their plant was a very big event, even though that the sort of supply that was taken offline wasn't that big. But especially for the Western market, where there's only 3 real conversion facilities and conversion centers, and the delay in the setting up of the Orano conversion center, it had a real profound impact, predominantly because Converdyne did very much what Cameco is doing on the U-Trade side right now, is they bought a lot of material or a lot of conversion into the market prior to shutting down the facility, and they really created a squeeze in the conversion market. And I think it's a good precursor for what potentially might happen in the uranium market as well. The same sort of factors play on both markets. There is for both markets a source of secondary supply from inventories, from underfeeding, from displacement via MOX and reprocessed uranium. And what we're seeing in conversion right now is that the market is very tight because there's very little inventory that's coming into the market and that people are willing to release. There's still inventories available, but people are not willing to release it, and notably thinking about, for example, the Japanese inventories or the long-only funds. And that's all created a really big squeeze into this market. And I believe that the same could be possible on uranium if there is enough supply that's gone offline right now on uranium that we are undersupplied. And if nothing changes, then ultimately there will be a squeeze in the market. But again, the timing and the severity of that squeeze are very much to be seen in uranium. It's that's the hardest part to focus on uranium, when and how it's going to happen.
Sure. Well, if we knew that answer right.
Exactly.
So we see more and more mines getting put into care and maintenance or just shutting down whilst demand keeps on increasing. Could you please let us know your thoughts on the industry overall?
I think, again, it comes down to the same thing what I said earlier. The price levels where they are right now, they're not incentivizing mines to stay open, or let alone increase new production or incentivize new production. It's taken a long time for the market and the mines to react to these low prices, mainly because uranium is usually, it's a long-term commodity. So a lot of the contracts are long-term contracts at fixed prices, meaning that mines can survive for longer than in other markets because they're covered by long-term prices. But in that sense, we see exactly what you would see in any other commodity. That is, if the prices don't incentivize mining, if they don't cover the mining cost, then ultimately the mine decide to shut down or be put on care and maintenance. And as long as prices are at the levels where they are right now, in the around 25 level or below, we will see this process incentivizing or carry on, in the sense that more mines might come offline. The demand is indeed increasing, mainly driven by the Chinese new reactor build program, but also don't forget about India and Russia, who are both expanding their reactor programs. So we'll ultimately need new mines to come online, or the mines that have been put in care and maintenance to come back online. If anybody would look at the WNA report that was recently released in September, you see that as time progresses, there is a very big divergence between what supply is available and what the demand side needs, and that supply that's available becomes less and less as mines start depleting as well. I guess the question is, there is mines available, there is more than enough resources. Uranium is a commodity that's abundantly available in the world, but it needs the right price to incentivize this production to come online. That's the underlying thesis for saying that the markets will ultimately need to recover the same way that the conversion market did, to price levels where it covers the marginal cost of production. But yet again, the time frame of that is difficult to understand, because there is all these secondary supplies that might come into the market or might not come into the market, which play a role in that game.
Brilliant. So Bram, before I let you go, in your opinion, what are the risks in the uranium market right now that people are not paying attention to, both on the upside and downside?
I think, one of the major risks, I don't know whether not paying attention is the right word, but that has been overlooked especially by utilities for a while, is the fact that as mines go offline, is that the squeeze on the supply side is not only happening in absolute pounds, but it's also happening in production centers. Where we used to have a good 10, 15 countries who are all producing uranium, the real production sources in uranium can be boiled down to about 4 or 5 countries right now, which means that utilities are overly exposed to the same countries. Most of them are geographically difficult locations. So if there's ever any sort of geographical or political matchup or difficulty, then that might have a big effect, and there might be a big exposure there for utilities. I guess a real big thing that's I wouldn't say missed, but probably misunderstood by the investor community is inventories and how inventories work in this space. I think we've spoken about it quite a lot already, but there is a big scare that Japan might release loads of their inventories onto the market. But I think we need to look at the mobility of those inventories. Our inventories are not just all held in deuterated form. There's a lot of material that's sitting in actual fuel rods, which don't particularly come into the market quite easily. And just in general, the Japanese inventory is not as mobile as most most people think. So that's a big effect. But also, I think the biggest part about inventory is that the absolute number of inventories that are sitting somewhere in the world and at different sources is a really large number. But it always has been, and it's mainly the change of inventories, whether inventories are increasing or inventories are decreasing, which has an impact on what prices do in the market. And I think that might be misunderstood by especially the investors community. And the other thing is the lead times that it takes to bring new mines online. Unfortunately, bringing uranium mining online is not just it's not drilling a hole and then getting it out of the hole. It takes 3, 5, maybe 10 years depending on the jurisdiction. So people and utilities specifically especially need to start planning for the long term. They need to start looking at their demand for 2030 and beyond already, because if they want to incentivize new production, they need to start looking at that right now, because there's not a lot of sources available right now that could come online straight away. Even the idle mines that are out there, it will take a few years for the mines to get restarted, and so by the time that the material is needed, it might be too late for them to restart. But also on the downside, there's also some risks and some parameters that need to be taken into account. The most prominent one is probably the most difficult one, which would be the policy. So the country policy on energy. A quick shift in policies can cause a dramatic effect on the demand for uranium, which is exactly what we saw with Germany, for example, when they decided to close all of their reactors. And as the energy market is moving more into CO2 neutral or carbon efficient production of energy, we see more and more demand potentially for uranium and nuclear, but it could also be easily displaced by solar and wind, where countries take a view that uranium or nuclear power is no longer part of a green energy policy and therefore shut down their nuclear reactors. So that's a big potential on the downside. Secondary to that is also the technological advancement in the space. As the space moves forward, there's more and more fuel developed that is more efficient, so it uses less uranium. There's different types of fuel developed. I'm thinking thorium fuel and thorium reactors. Most of those factors are probably very long term and won't be really developed until 2030, 2040 and beyond. But it's definitely something to keep an eye on to understand where the long-term demand for uranium is going to go.
Brilliant. Those are all great points, Bram. So again, it was a pleasure to talk to you. Your insights are very valuable, and I can't thank you enough for coming to this program.
You're welcome. No problem. Thank you very much, Marcelo. Thank you.
Talk to you soon, Bram.
Bye-bye.
Cheers. Bye-bye.
If you like this podcast, feel free to forward it to your friends and colleagues. We appreciate your time, support, and your feedback. You can follow Marcelo López on Twitter at MALopez1975. The information presented here is not investment advice and should not be taken as such. You should do your own due diligence and consult with your financial advisor before doing anything suggested or mentioned in this podcast. L2 Capital and its partners will not be liable for any losses that occur in doing whatever is discussed in this podcast.